The solution everyone is waiting for no longer exists. For years, the story has been reassuring. Inflation rises, the central bank steps in, rates go up, confidence returns. That playbook worked once. It's still treated like law, but the structure that made it possible is gone. In the early 1980s, crushing inflation meant raising rates high enough to cause pain. It worked because the system could absorb it. Today, that same move would do something very different. It wouldn't restore confidence. It would tear open the balance sheet underneath everything. This isn't a theory. It's a constraint, the kind that turns policy into theater and choices into illusions. And this matters to you more than most people realize. Because when a system can't defend its currency without threatening its own survival, the consequences don't stay on spreadsheets. They show up in prices, savings, markets, and timing. Quietly at first, then all at once. Here's the contradiction driving everything forward. Inflation demands discipline. Debt forbids it. Once you see which force has the leverage now, the rest of this story stops being confusing. It starts becoming predictable. What's unfolding now isn't a sudden crisis. It's a delayed consequence. The core event looks familiar on the surface. Inflation hasn't been fully brought under control. Rates moved up, but not far enough to change behavior. At the same time, government debt has grown so large that the cost of servicing it is no longer a background issue. It's front and center. That alone reshapes every decision that follows. But don't treat this as an isolated moment. This is part of a longer pattern. Each cycle relies more heavily on debt. Each intervention leaves less room to maneuver. What used to be emergency policy slowly becomes baseline policy, then expectation. Notice how the framing has shifted. The question is no longer how do we end inflation? It's how much pressure can the system tolerate? That's a very different problem. Here's the reframing question that matters. If the tool designed to fix inflation now threatens the system itself, what happens when inflation doesn't cooperate? Because once the cure becomes more dangerous than the disease, decisions stop being about solutions. They become about postponement. And postponement always comes with a cost that shows up later, somewhere else. There's a claim underneath this that sounds extreme until you look at the numbers. The system can't raise rates enough to win. Here's the concrete detail that forces that conclusion. Interest payments on U.S. debt have pushed past $1 trillion a year. That single expense now rivals or exceeds what's spent on entire core functions of government. And every move higher in rates compounds that burden immediately. Not over decades, right now. This is where fact and inference separate. Fact, debt servicing costs explode as rates rise. Fact, debt levels are far higher than in past inflation fights. Inference, policy is boxed in long before inflation is defeated. And notice what's missing from official reassurance. There's no serious roadmap to restoring positive real returns for savers. No commitment to rates staying above inflation long enough to reset behavior. Just language about balance, flexibility, and monitoring conditions. That gap matters because markets don't wait for speeches to change. They respond to constraints. When capital realizes that discipline is financially unaffordable, it adjusts expectations on its own. Here's the part people underestimate. This isn't about a single decision to go easy. It's about incentives quietly steering outcomes. The structure rewards easing. It punishes restraint. Once that becomes obvious, confidence doesn't collapse in a headline moment. It erodes through behavior, through positioning, through the things people stop believing will ever happen again. And when enough participants reach that conclusion, the system's options narrow fast. Now watch how this pressure changes the system itself. In past cycles, tightening was treated as a test of credibility. Pain was expected. Recessions were tolerated. Breaking excess was part of the process. Today, that mindset has flipped. The tolerance for pain has collapsed, not emotionally, but structurally. The system is too leveraged to absorb it. So instead of discipline, you get delay. Instead of resolution, you get management. Large deficits stop triggering urgency. High inflation gets reframed as sticky or transitory again, and tools that were once extraordinary quietly become permanent. This is how abnormal becomes normal, not through deception but through repetition. Compare the posture now to earlier eras. Back then, policymakers were willing to force a reset even if it caused short-term damage. Now every move is weighed against the risk of something snapping underneath. Financial stability stops being a goal, it becomes a constraint. Here's where the story flips. When a system can no longer afford to enforce discipline, it starts protecting leverage instead. And once leverage is protected, behavior adapts around it. Risk doesn't disappear, it just gets redistributed and delayed. And the longer that delay lasts, the more violent the adjustment becomes when it finally arrives. Here's where the contradiction becomes impossible to ignore. Despite all the talk about tightening, real returns remain negative. Rates sit below the pace at which purchasing power is eroding. That means holding cash or government debt guarantees loss in real terms. Not as a risk, as a condition. In the past, this was the breaking point. When savers were finally rewarded with returns above inflation, behavior changed. Money moved back into cash, speculation cooled, hard assets cracked, confidence reset. But that mechanism isn't operating now. Look at the mismatch. Officials signal restraint, but the structure enforces accommodation. The system cannot sustain rates high enough, long enough to reverse inflation without triggering a fiscal shock. So language stays tough while outcomes stay soft. This is the line that permanently changes how you see the system. Cash is no longer a neutral position. It's an active decision to accept erosion. Notice what disappears from serious discussion. There's no commitment to making savers whole. No plan to restore purchasing power. Just assurances that conditions are manageable. That gap between words and reality matters more than any single policy move, because once people understand that inflation must outrun rates for the system to survive, trust doesn't break all at once. It drains away, and when it does, capital doesn't wait for confirmation. It moves first. At this point, pressure doesn't build in one place. It stacks. Markets start doing what policy can't. Asset prices rise even as fundamentals weaken. Things that shouldn't move together begin climbing at the same time. Risk assets and defensive assets stop taking turns. They surge side by side. That's not optimism, that's currency stress leaking into behavior. Then the tempo changes. Rate cuts stop being distant hypotheticals and start sounding like contingency plans. Liquidity returns quietly, not because inflation is beaten, but because something else feels more fragile. Control shifts from steering to reacting. Watch how fast narratives adjust. One moment it's about discipline, then it's about flexibility, then it's about avoiding unintended consequences. Each step feels reasonable. Together they reveal loss of control. This is how systems slip, not through collapse but through speed. Small decisions pile up. Momentum replaces intention. And once that happens, reversing course becomes harder than staying on it. Here's the question that now hangs over everything. What happens if this continues? Not for months, not for a cycle, but as the default setting. Because when acceleration becomes policy, outcomes stop being chosen. They arrive. Now bring it out of abstraction and into daily life. When inflation runs hotter than rates, the damage doesn't feel dramatic. It feels constant. Your money doesn't disappear, it just works less. Each month, the same income covers a little less ground. Each year, prices reset higher and refuse to come back down. This is where the system reaches you. Waiting stops being safe. Saving feels like falling behind. Decisions that used to reward patience now punish it. So people adapt, not out of greed, but out of necessity. They move faster, they take risks they wouldn't normally take, they stay exposed longer than they're comfortable with. Housing doesn't correct the way it used to. Insurance jumps without warning. Food, energy, and basic services stop feeling temporary. And being told things are strong starts sounding disconnected from what daily choices require. Remove politics from this and the pressure still exists. A system that can't protect purchasing power forces everyone into motion, even those who don't want to play the game. If this feels familiar, say so in the comments. Because when ordinary decisions start being shaped by monetary survival instead of opportunity, that's not just a rough cycle. That's stress being pushed outward. And it doesn't stop at households. To make sense of why this keeps repeating, you have to look past personalities and focus on incentives. This system isn't driven by intent. It's driven by structure. A debt-heavy system cannot tolerate conditions that make debt expensive. So everything bends around that fact. Policy language softens, timelines stretch, liquidity gets prioritized over discipline, not because anyone says so explicitly, but because anything else breaks the machine. There's another layer too. Asset prices act as cover. Rising markets create the illusion of health. Nominal gains distract from real erosion. As long as portfolios look stable on screens, deeper problems remain tolerable. The system learns that inflation is survivable if it's masked by asset appreciation. Fear completes the loop, not panic, but restrained fear. Fear of tightening too far, fear of triggering something that can't be controlled. So decisions become cautious, reversible, and incremental. Over time, that caution hardens into policy. Here's the uncomfortable insight. This system doesn't need to collapse to change outcomes. It only needs to persist. When incentives reward debasement and punish restraint, the direction is set long before anyone admits it. And once that's clear, outrage stops being useful. Understanding the mechanism matters more. From here, the trajectory splits, but neither path offers relief. One path is slower and smoother on the surface. Inflation stays elevated but contained. Rates drift lower under the language of support and stability. Markets keep rising not because productivity improves, but because the currency underneath them weakens. On paper, wealth grows. In reality, purchasing power keeps leaking away. This path depends on confidence lasting longer than fundamentals justify. The other path is sharper. Inflation resurges or an external shock hits. Rates can't rise enough to stop it without detonating the debt structure. Policy hesitates, markets move first, liquidity vanishes where it's needed most. What looked manageable suddenly isn't. Neither outcome requires a dramatic announcement. Both emerge through momentum, delays compound, expectations harden, and once alignment breaks between debt, policy, and credibility, adjustments accelerate. Here's what matters most. You don't need to predict which path wins. You only need to see that the system is already leaning forward. The next move isn't planned, it's forming. And when it becomes obvious, it won't feel sudden. It will feel inevitable. Here's the insight that pulls the entire picture into focus. This isn't about a bad policy cycle or a temporary imbalance. It's about a system that expanded beyond the limits of its own controls. The tools that once restored trust now threaten stability. So the goal quietly changes, not to fix the problem, but to keep it from detonating. That's why everything feels contradictory. Strength gets measured in appearances. Stability gets defined as motion. And erosion happens without a single breaking headline. If you've sensed that the official story sounds calm while reality feels tighter, that's not confusion. That's the system operating in the gap between numbers and lived experience. This story doesn't end with a clear crash or a clean reset. It continues through adjustments that slowly redefine what normal means. And by the time that shift is obvious to everyone, positioning is no longer a decision. It's already been made. If you want to keep tracking what's forming beneath the headlines, follow and subscribe. The next layer of this story is already moving into place, and once it's visible, understanding comes too late. Pay attention while there's still time to choose.